There is a very peculiar feeling that almost anyone who has lived through a market crash knows well. It's not the panic when everything is collapsing. It's that quiet, vague, uneasy feeling before the storm hits. You sense something isn't right. The market atmosphere feels too excited, too confident, too perfect. Everyone around you seems to be making money, even people who don't understand investing at all. Friends are boasting about returns on social media. People who never cared about finance suddenly become experts, and deep inside, a small voice whispers, "Can this last? Or am I standing in a bubble that's about to burst?" That question, that feeling, is the point where smart investors begin to separate from the crowd. And today, I want to share a truth history has proven again and again. Before every major market crash, the mood of the market starts to rhyme. The details change, the names change, the technology changes, but the pattern feels eerily familiar. Now, let me be clear. This video is not about predicting a crash. Predicting the market with perfect timing is basically impossible. If you try, you'll either sell too early, buy too late, or drive yourself insane checking charts every day. The goal is not to become a prophet. The goal is to become calm, to understand what's happening around you, so you don't get pulled into the madness, and so you already know what to do if things start to unravel. Because here's what most beginners don't realize. The biggest damage from a crash doesn't come from the crash itself. It comes from what people do emotionally right before it and right after it. They chase near the top. They panic near the bottom. They turn a normal cycle into a personal disaster. So if we can spot the pre-crash atmosphere, we can protect ourselves from the biggest mistake, becoming the crowd. So let's talk about what always happens before a crash. Not exact dates, not exact triggers, but the common signs that show up again and again. The first sign, and the most obvious one, is excessive market euphoria. This is when the market stops feeling like investing and starts feeling like a party. People aren't asking, "Is this a good business?" They're asking, "How fast can this go up?" You see headlines that sound like destiny. You hear phrases like "new era," "new economy," "this time is different," and it feels like the rules of reality have changed. Think about the dot-com bubble. Companies with no profits were worth billions because they had a website and a cool story. Think about the 2008 housing mania. People believed housing prices could never fall because everyone needs a house. Think about different tech frenzies, meme stock waves, crypto booms. Different stories, same energy. The belief that risk has disappeared. And when risk disappears, people start paying any price. Valuation metrics stretch far beyond normal. A stock might trade at a price that only makes sense if the company becomes perfect. Investors stop caring about earnings. They stop caring about cash flow. They stop caring about basic math. They care about momentum and hype. This is where something called the greater fool thinking takes over. People don't buy because they believe it's worth the price. They buy because they believe someone else will pay even more later. It's not investing. It's a hot potato game. And the scary part is, it can work for a while. That's why it's so seductive. It rewards bad behavior in the short term, which makes the crowd believe it's genius. Here's a simple way to feel this sign in real life. When you hear more people talking about money than ever before, but they're not talking about long-term plans, they're talking about quick wins, they're talking about "this will double," they're talking about easy money. When markets feel too easy, danger is often building quietly. The second sign is the rush of money into high-risk assets. This is closely tied to euphoria, but it has its own flavor. Before a crash, new investors show up in huge numbers. People who never invested before suddenly open apps. They buy things they don't understand. They don't know what a balance sheet is, but they know what's trending. It could be IPOs of companies that are losing money. It could be coins with no real use. It could be hyped funds promising unusually high yields. The common thread is the same. Money flows to risk, and people stop calling it risk. They start calling it opportunity. This is where FOMO becomes the fuel. Fear of missing out doesn't feel like greed. It feels like anxiety. It feels like, if I don't buy now, I'll be left behind. It feels like everyone else is getting ahead and I'm stuck. That emotion makes people abandon common sense. They stop asking what could go wrong. They only ask, how much can I make? And the market notices. Prices rise faster, volatility increases, and the crowd becomes more sensitive to every rumor, every tweet, every headline. That's another pre-crash signal. The market starts moving like a nervous animal. Big moves on small news, hype reactions, fear reactions. It becomes emotional. Now, let's make this even more practical. One of the clearest signs of this rush into risk is when people start borrowing to invest. Margin, leverage. I can't miss this. This is where bubbles become dangerous, because once people are borrowed up, small drops turn into forced selling. The chain reaction becomes possible. That brings us to the third sign, and this one is more subtle, but is often the most important. Early warning signals from the credit side of the economy. Many crashes don't begin with stock charts, they begin with stress in debt and credit. The stock market is like the mood of the crowd. The credit market is like the health of the body. If credit starts to tighten, if borrowing becomes harder, if interest rates rise, it becomes harder for companies and people to keep spending and growing. And when growth slows, stories break. And when stories break, prices fall. One example many people talk about is the yield curve, especially when it inverts. In plain terms, an inverted yield curve happens when short-term interest rates are higher than long-term rates. It can signal that people expect slower growth in the future. It's not a perfect crystal ball, but historically it has often shown up before major trouble. Other credit signals include rising consumer debt, increasing default rates, shaky corporate borrowing, or banks getting more cautious. Central banks tightening policy can also matter. When interest rates rise, it changes everything. Loans cost more, mortgages cost more, businesses face higher costs. The pressure builds quietly, while the public is still celebrating gains. And here's why this sign is so dangerous. Most people don't watch it. When a bubble is forming, everyone is focused on the exciting thing. Nobody is looking at the boring plumbing underneath. That's why crashes feel like surprises to the public. They're not always surprises. They're often slow problems that finally snap. Now, at this point, a beginner usually asks the big question. Okay, so if we see these signs, should we sell everything and move to cash? And the honest answer is, not automatically, because warning signs can appear long before the crash happens. Markets can stay irrational longer than you think. That's why people who try to time crashes often get burned. They sell too early, then watch the market keep rising. Then they get pulled back in at a worse time, or they stay out so long they miss the recovery. There's a famous joke from economist Paul Samuelson. The stock market has predicted 9 of the last 5 recessions, meaning markets can panic early and often. So the goal isn't to guess the exact day the storm hits. The goal is to prepare in a way that works no matter what. So, what should you actually do when you sense the pre-crash atmosphere? You do 3 things. You check your exposure, you strengthen your foundation, and you write your behavior rules. First, check your exposure. Ask yourself simple questions. If the market drops 30%, will I be okay? Not emotionally, literally. Will I still be able to pay my bills without selling investments? Am I overly concentrated in one hot sector? Do I own a bunch of things I don't understand just because they were trending? Am I borrowing to invest? Am I depending on constant growth to feel safe? If any of those questions make you uneasy, that's your signal to reduce risk while things are calm, not in a dramatic way, in a smart way. You trim the stuff you don't understand, you diversify, you stop gambling with money you can't afford to lose. Second, strengthen your foundation. This is where real crash protection begins, and it's not exciting, it's basic. An emergency fund, low debt stress, a plan you can stick to. If you have 6 to 12 months of living expenses in a safe place, you don't panic when markets drop. You can ride it out. You can keep investing. You can sleep. Most panic selling happens because people don't have a cushion. They're forced to sell, or they feel forced. So building a cushion is not boring. It's power. Third, Write your behavior rules before you need them. This is the money psychology part. When the market gets scary, your brain changes. You stop thinking clearly. You start seeking certainty. You start wanting relief. That's why you need rules written when you're calm. Rules like, I will not panic sell. I will keep investing on schedule. I will not make big decisions on a scary day. I will wait 48 hours before doing anything drastic. If prices drop, I'll treat it like a sale, not a disaster. These rules aren't motivational quotes. They are guardrails. They protect you from becoming the crowd. And here's a key reminder. Market crashes are painful, but they are also part of how wealth is built. The market has recovered after every major crash in modern history and gone on to reach new highs. But not everyone benefits from that. Only the people who stay in the game do. The people who sell near the bottom often miss the strongest recovery days, and missing those days can change your entire outcome. That's why a crash isn't just a test of your portfolio, it's a test of your behavior. So when you ask, what always happens before a crash, the real answer isn't a magic sign, it's a pattern. Euphoria rises. Risk gets ignored. Money floods into hype. Credit stress builds quietly. Then something breaks, and the crowd reacts too late. And your job as a beginner investor isn't to predict the exact moment the break happens. Your job is to be awake, to not get hypnotized by easy money, to build a portfolio you can hold through storms, and to have a plan for your emotions. Because in investing, winners aren't the ones who predict storms best. Winners are the ones who build a ship that can handle storms and stay calm enough to steer. If you found this helpful, share it with a friend who's getting a little too excited about easy gains. Sometimes one reminder at the right time saves someone from their most expensive mistake. And if you want more simple investing psychology like this, how to stay calm, how to avoid panic selling, and how to build long-term wealth without getting swept up in the crowd, subscribe.